First, for Sales Tax and More, Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, and like our name states, more. So if you have questions about our services or you'd like to work with us, please reach out. We would love to hear from you. We would love to work with you as well. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well-rounded, and he has helped thousands of companies of all sizes and all industries, and is especially well-known in the e-commerce industry. And with that, Mike, why don't we go ahead and get started?
Absolutely. Thank you, Ellie, for that wonderful introduction, and welcome everyone. We appreciate you joining us today. We've got a lot to cover. We're going to start out with some Nexus definitions, some court cases. We're going to talk about the two major categories of Nexus, economic Nexus and physical Nexus. We're going to debunk some myths. We're going to go over some case studies, and we're going to talk about how states find you, and we're going to go over some South Carolina specifics. So a lot to go over. And as we always say, the worst time to find out that your clients have problems is when the state's contacting them. Either they're being audited or they're getting Nexus questionnaires, could be by phone, could be by email, could be by regular snail mail. And the reason why it's the worst time to find out there are problems is because there are mitigation programs that are available to you if you're being proactive. If you're waiting for the state to reach out to you or to your clients, a lot of those mitigation programs are off the table. They're no longer available. So that's why it's the worst time to find out. If you're being proactive, you have a chance to mitigate some of these exposures. All right, so let's go to a Nexus definition. And it's really just a fancy word that means link or connection. I got this definition from the internet. And what it basically says is a connection or link between things, persons, or events, especially that is or is part of a chain of causation. I think that's a pretty good definition. Now, when we're talking about taxes, it's the link or connection with the state which must be present before the state can require you to do anything, like collecting or paying its taxes. So that's why we say it all starts with Nexus. Because if you don't have any Nexus, any link or connection with these states, the state can't require you to do anything. So no link, no Nexus, no problems, and no responsibility. Now, the problem is many companies, and sometimes their advisors, there are a lot of accountants out there that don't know where their clients have Nexus. And sometimes, these companies know, and you do your best to convince them to take action, but for whatever reason, they don't take action. So we say Nexus is the first step. It all starts with Nexus, but Nexus does not necessarily mean you have a responsibility to file. It just means that you have a link or connection with the state that may require you to, or your clients to register to collect the tax. The two next steps that you need to look at are determining taxability and materiality before you go ahead and get registered. Now, taxability is important because a lot of states say if you don't have any taxable sales, then there is no need to go ahead and get registered. Why file $0 returns? I mean, the state has to process them, and they're not getting any money. So a lot of states just say, hey, no taxable sales, don't worry about it. And even the states that do say you should still get registered, since most of the penalty and interest out there is related to, taxable sales. If you have zero taxable sales in a number of states, then you have zero penalties. So a lot of clients of ours choose not to go ahead and get registered and collect the tax if they have zero taxable sales. Now, some states say that you should still do it and they have penalties for non-filing, like $50 penalties or something like that. So you got to look at this on a state-by-state basis. Now, materiality, that's my comments. That's my concept. That is not the states. The states believe that you should be collecting once you cross a threshold, or once you develop a physical presence in the state. They want you to collect from the moment that you have that nexus, once that link is created. However, I think we need to use common sense when we're talking about materiality. I mean, if the cost of compliance is going to exceed any back taxes plus penalty and interest, I don't think it makes sense to file. I'll give you an example. A lot of these states still have 200 transactions, a little less than 50% as a threshold for economic nexus. We're going to talk about that more. But if you're selling a $5 item, 200 is $1,000, and the tax on that is going to roughly be $80 or so. If you use 50% penalty and interest, if you don't pay it every year, it's going to be roughly $120. Now, I don't know about you, but in most of the places I look, it's going to cost you more than $120 to go ahead and get registered in the state. Even if you're doing this yourself, time is money. So it takes time to get registered. If you're going to pay someone like us, that's an actual cost. And then someone's got to file the taxes. And in some states like Georgia, they say, hey, for the first 6 months, you're going to be a monthly filer no matter what. Other states say for the first 12 months. And the thresholds are really pretty low to stay a monthly filer. Some states are going to say you're a quarterly filer, but if you got some monthly states in there, now someone's got to file 12 returns over the course of the year. And I just don't know how you justify doing all of that work, jumping through all of those hoops, just because the state says to do so, because you've crossed this $200 threshold. I mean, even, if your sales stay the same and it's the same $1,000 in sales over 5 years, that's 5 times 120, that's $600. You would pay far more than that trying to be compliant. So I think that we have to use some common sense here. Just because the state says you should do it doesn't mean it makes good business sense. A lot of times, it makes more sense to wait for the state to find you, and then you pay the state out of your own pocket, because that cost of compliance every year is going to exceed the cost of the back tax plus penalty and interest. Now, everyone says, well, Mike, what is material? And I can't decide that for you. Let's use Coca-Cola as an example. I mean, $100,000 to Coca-Cola, not material. It's really like a rounding error, where to me, $100,000 is a heck of a lot of money. So each of your clients needs to determine what is material for them. Now, I can tell you what I don't think is material. I can never make the math work if your taxable sales are below $3,000. Depending on which state it is and how you're going to register and file your taxes, I find it hard even up to $5,000 to make the math work so that it is worth doing what the state says to do. Now, I'm a big believer. If these numbers are material, you have got to get registered because, as your business grows, the numbers keep growing and they don't go away. If you've never been registered, if you've never filed a return, there is no statute of limitations. So as this becomes material for you, you've got to take care of it. Now, how do your clients determine what's material for them? Well, risk tolerance is a big one. We have lots of people calling us and saying, Mike, I'm really worried about this. Shopify told me to go ahead and get registered. I have 200 transactions, or so-and-so told me I should be registered, or, what's your opinion? And, if they're really, really, on the verge of a nervous breakdown, and some of our clients are, then maybe they get registered at that $3,000 number or that $5,000 number. There's something to be said for peace of mind. Now, we have plenty of clients who say, well, Mike, I go to Vegas every week. I never lose. Nothing bad has ever happened to me in my life. And I don't think the state's going to find me. Now, that's a little bit of an exaggeration, but it approximates that. For those people, maybe they have a higher personal threshold. So if we look at 80% of our clients, they're between that $3,000 number and a $20,000 number. If we, 100% of our clients, if we drop down to 80%, then we're going to see our clients getting registered. It used to be from 5 to 10,000. Right now, we're seeing a little bit of a creep. I'd say 7,000 to 12,000 is where 80% of our clients begin to say, okay, this is material and we want to get registered. So risk tolerance, big determining factor. The second one is profit margins. I mean, we talk to some of our clients and they say, well, Mike, we're trying to grow the business here. So we're working on a 2% profit margin. Well, that's great. It's a whole nother story. We got to talk about when you raise your prices, your business is going to go away if you're basing everything on price. But what's really important here is that most states, the tax rate, if we use an average, it's going to be 8%. Now, some are going to be more, some are going to be less, but if we average it out, it's going to be right around 8%. So if a state finds you not today, but if they find you, 3, 4, 5 years from now, and your numbers are material, then not only have you wiped out your profits in that one state, 8%, 2%, that's a 6% negative, and that's before we add penalty and interest. You may have put yourself out of business because states talk to each other also. So you got to watch out for that. So it may not just be this one state, it may be a couple of states. And I've literally seen companies go out of business because they didn't take this into account. Now, if you tell me, Mike, I've got, 50% profit margins, 70% profit margins, then you got a little bit more room in there. And this is really counterintuitive. The people who have small profit margins say, hey, we don't have enough money to pay for this. But it's those people's especially that need to take care of this. It's like insurance, insurance doesn't add any value to, if we're talking about property insurance to the property. I've got, a number of rental properties and, some of them are free and clear and, I don't have to have insurance on them, but I do so anyway, just in case. I don't think they're going to burn down, but if they do, the penalties, not the penalties, the premiums are going to seem like pennies compared to the money I need to repair or replace those properties. And I look at, tax compliance the same way. Yes, there's a cost of compliance, but they're going to seem like penalties. They're going to seem like pennies. I'm getting tongue-tied this morning, compared to, if the state does find you and you got to pay all of this money out of your pocket. So profit margins give you a little bit more room, but the smaller your profit margin, the more important it is to have a lower personal threshold than a higher personal threshold. And I know that's counterintuitive. And then capital reserves. If you got a lot of money in the bank and you think that, paying the state if and when they find you is not going to hurt your cash flow, then you have a little bit more room. But even big companies can have problems with this. I mean, I've had to work out payment plans on, $50 million, $100 million companies because it was the third quarter, going into the busiest time of the year. They had all of their money tied up in inventory and they couldn't afford to pay the state. So we had to work out payment plans. So, it's not just small companies that need capital reserves. The bigger companies, you got to see where their money's tied up. And if you don't have a lot of free capital reserves there, then you need to have lower thresholds. So these are the things that our clients look at when determining what their personal thresholds are. I keep saying personal because, again, the state believes once you have Nexus, once you develop this link or connection, that you should be collecting and remitting the tax. All right, so there are two primary types of Nexus for sales and use tax. You have your physical Nexus, which is the traditional Nexus. This is what's been around forever. Now, there are different types of physical Nexus. Some are obvious, some are not, some are common, some are less common. We're going to go over all of those. And then you've got your new Nexus, which is this economic Nexus. It came about as a result of the 2018 Wayfair, South Dakota case. And the thresholds are based on revenue and or transactions. So we're going to go over some examples of that. But it's important to remember that each state has different thresholds and effective dates. All right, so let's look at some court cases before we get into some specifics. And this first one here, it's always been important, but nowadays, since the pandemic, it's becoming more and more important. And the takeaway from this National Geographic versus Board of Equalization, and these are all Supreme Court, U.S. Supreme Court cases, by the way. The takeaway is that taxable activity does not have to relate to the nexus creating activity. Said another way, once an entity has nexus, that nexus is for all of the business channels. The business channels don't have their own independent nexus. It's the entire entity. And the reason why this is so important right now is because during the pandemic, a lot of companies that were distributors or wholesalers or, not selling to the end consumer, they got hurt pretty badly. But the companies that were selling online to the final consumer, they did very well. So a lot of these companies have now decided to, dip their toe in the water or go full bore, and they're starting to sell online. And number one, we have found that a lot of accountants don't even know that their business model has changed a little bit, that they've added online sales directly to the consumer. That's important that you know that. But number two, a lot of these companies, have had, wholesale reps all across the country for the last 20 years. And, they didn't worry about it because they didn't have any taxable sales. But now, once they start selling directly to the consumer, they've got taxable sales. And a lot of these companies are saying, well, we haven't crossed the $500,000 threshold in Texas yet, or the $500,000 in California yet. Once we do, we'll get registered. Unfortunately, it doesn't work that way. These wholesale reps who have been all across the country in any state they've been, traveling to or residing in, or, performing services on behalf of the company, that has created Nexus. So on day number one, once you start selling on the internet, there's a responsibility to collect the taxes. So this is catching a lot of companies by surprise, more important today than in a long time. Now, if you've got smaller clients that are selling online, especially, these FBA sellers, they've all got a lot of the same mindset. And they don't think that the states have the authority to tax them. They think that only Congress can impose taxes on interstate commerce. Well, unfortunately, back in the 1930s, when the first, modern day sales tax came into the US, they were right. But that's changed. And since the 1950s, that's really a concept that's been getting chipped away at. And in 1977, the Supreme Court said, yes, a state can tax interstate commerce as long as it meets a four-pronged test. And it's a pretty easy test to pass. So in 1977, we started seeing a blurring of the lines between use tax and sales tax. But that's for another webinar. But yes, states do have the right to tax interstate commerce. So it's not just Congress who can regulate it. Some other important cases, Scripto, and these are for physical nexus. And these are probably the two most important physical nexus cases that I know of. And Scripto, the pen company, back in 1960, Florida came to them and said, hey, we think these 10 independent contractors in the state of Florida create enough of a significant presence that you need to be collecting and paying our taxes. And Scripto said, you're out of your mind. We don't control these people. I mean, they're true arm's length, transactions here. They're not employees. And it goes to the Supreme Court. And unfortunately, the Supreme Court sides with Florida. And they say the difference between an employee and an independent contractor is without constitutional significance. And this gives rise to what we call attributional nexus or agency nexus. I try to keep it simple. I say third party nexus. Yes, third parties can create nexus for you. Now, this is revisited in 1987. Tyler Pipe's a Texas company. State of Washington comes after them and says, hey, you need, according to Scripto, to be paying our business and occupation tax. And Tyler Pipe's argument is, no, this is not like that at all. Unlike Scripto, where those people, represented Scripto alone, this person represents multiple companies. They're really not very good at their job, so they're like less than a part-time person. So we don't think that this fits Scripto at all. And unfortunately, it goes to the Supreme Court, and the Supreme Court comes back. And this is a very, very important case. I'm going to paraphrase the first part. The second part that is really important. And what the Supreme Court said is it doesn't matter what you call someone. It doesn't matter how you pay them. Doesn't matter if they represent you exclusively or multiple parties. Doesn't matter if they do it on a full-time or part-time basis. Here's what's important. If they're helping you to establish or maintain a market, that is probably nexus creating or can create nexus. The reason why that language is so important, establish or maintain a market, is because the states took that language and incorporated it directly into their statutes, their rules, their regulations, their guidelines. If you go to a court, state court, what better case to use as precedent than a U.S. Supreme Court case? So this language is very, very important. And a lot of people don't think of it, whether they're the companies themselves or their advisors, their accountants. When we think of what activities we have that are going to create this link or connection with the state, we don't very often think of the activities of third parties creating a link or connection for our clients. And that's why, since I've been doing this has been the biggest issue for states with going after companies that are using third parties in the state. They catch most people unawares. Biggest cause of problems when it comes to Nexus, until we get to the Wayfair case and economic Nexus. So we're going to talk more about physical Nexus later, but third parties, this is a big one. You got to look out for this one. All right. And then there's the Wayfair case, and it overturned Quayle. Quayle was the 1992 case that affirmed that, yes, there had to be a physical presence. And National Bellis Hess was the original case. It was 1967. Now, the Supreme Court didn't come out and just say, hey, times have changed. So we're going to, get rid of these two cases. They said we were wrong. We never should have introduced the concept of physical presence to begin with. And it's caused a bunch of problems. We really unintentionally created a protected class. So we're overturning these cases. And it's like those two cases never happened when the Supreme Court comes out and overturns those cases. So in theory, states could have went back to 1967. And the court was worried about that. So South Dakota was the state in this case, and they said we're only going to do this prospectively, and that was very important. Now, South Dakota thought $100,000 or 200 transactions were fair, and what we're talking about here is this linker connection. When we're talking about economic nexus, the linker connection with a state can be based on either sales or transactions, or either one of those or both of those. So very, very important. You no longer need a physical presence in order to create nexus. It can be an economic nexus. As of now, all states with sales tax have thresholds. Missouri was the last state, and they became effective on January 1st of this year. Their threshold is $100,000, no transactions. Even Alaska, which doesn't have a state tax, they have lots of local level taxes. They've got a threshold, and it's $100,000 or 200 transactions. Now, when we're talking about economic nexus, I want to cover a couple of points here. Number one, this is not an internet issue. It's a multi-state tax issue. There are a number of accountants that our salespeople talk to that still believe this is an internet tax. There's a lot of potential clients that we talk to, a lot of companies that we talk to that still refer to this as the internet tax. It is not. You don't even have to have a website for this to impact your clients. I mean, they can be selling entirely over the telephone. They can be selling entirely by referral. They can be selling by infomercial. They can be selling by catalog. I mean, it literally doesn't matter how they're selling for them to be impacted by this. If they're selling into multiple states, this can impact them. So it is not an internet issue at all, although a lot of this is done over the internet. So yes, selling over the internet will trigger this, but it's not the only thing, and this is not an internet tax. Another important thing, this does not override any other type of nexus. And here we are 5 years into this, and we still have companies saying, hey, Mike, I need to deregister in this state. And I say, well, why? And I say, well, it's California. They don't have any transactions. It's $500,000, and I'm underneath $500,000. And, if it's a client, I'll come back to them and say, well, last time we talked, you had inventory in California. Oh, yeah, I still have inventory in California. But I'm underneath the $500,000. And at that point, I have to break it to them. I'm sorry, it doesn't work that way. This economic nexus For sales tax, income tax, another story, but for sales tax, it doesn't protect you. It does not override any other type of nexus. It's just one more way that the states can get you to do what they want, which is collect or pay their taxes. And it could be any state, Texas, same thing, $500,000, no transactions. People tell me, want to get deregistered, and I'll say, well, last time we spoke, you had an independent contractor traveling into the state. Well, yeah, I still do. Then I have to tell the same story. So it does not override any other type of nexus. In fact, when it comes to sales and use tax, a physical presence is almost always going to trump an economic nexus. All right, so we said that South Dakota made the U.S. Supreme Court comfortable because they said they were only going to enforce this prospectively. In other words, going forward. But that's from the effective date. On day number one, nobody had any past exposure, but here we are, 5 years out, and these effective dates are getting old. You don't want to procrastinate here. I mean, there was a recent survey that said 1 out of 2 companies, or 50%, are not compliant. I saw another survey said 60% of companies are not compliant for economic nexus. You've got South Carolina questioning registrations, the remote seller registrations. You got South Dakota questioning registrations. This is the start date. When did your nexus begin? That's what they're questioning. The states of Illinois and Wisconsin and Maine, they're actually auditing companies, and Illinois and Wisconsin are going back and auditing everybody. I mean, we had one client who got registered in Illinois on July 1st of 2019. And, the statute became effective in October of 2018. So what are you looking at here? 3 months. And 3 years later, in late 2021, the state of Illinois started sending out notices, and they wanted this company to pay the 3 months plus penalty and interest, 3 months of back tax. So they were one of the lucky ones. It was only 3 months. I mean, there are other companies that registered prospectively, and they're going back, 4 years now, 5 years, when it comes to this October. So it can be quite sticky. Wisconsin was the second state. Maine is the third state. Now, Maine did away with their 200 transactions. So I don't know if when they're going backwards, if they are going to utilize the rules that were in place at that time, or if they're going to go with the new rules. Knowing how states work, I would anticipate that they would use the rules that were in place at that time. So you've got at least 3 states auditing all, Illinois and Wisconsin auditing all registrants. They're going to get around to everyone from what they say. Maine being very aggressive and auditing at least some registrants. So we'll see how, what Maine does on a going forward basis. Now, other states, Alaska, Florida, Kentucky, they're sending out notices and say, hey, we have reason to believe, or we think that you should be registered for this economic nexus. In the case of Florida, they've got a list of people they believe are over it. We think that they got that list from Amazon. Utah went out and purchased a list. They were being a little bit more aggressive in sending their letters. But the states, as we go into recession here, they're going to be looking to increase revenues, and they know at least 50% of the companies are not compliant for this, and they're going to be stepping up their enforcement. All right, so there's been a trend away from the transactions. So I mentioned Maine. So the companies up there right now, California, Colorado, Iowa, Maine, North Dakota, Washington, and Wisconsin started out. For example, California started out with $100,000 and 200 transactions. They followed South Dakota. But then they said, hey, we're California. That may be good for South Dakota, but it's not good for California. So they're at $500,000, no transactions at this point. So all of these states have gotten rid of the 200 transactions. And I find it ironic. South Dakota, which is the one who implemented, they were the first ones to implement the $100,000 or 200 transactions. I mean, we had a Supreme Court case based on this, yet they just announced that they're going to do away with their 200 transaction threshold in July of 2023. The second group in there, this group of states have never had any transaction thresholds. They've always been based on revenue. And then Connecticut and New York are a little bit different. They don't have any standalone transactions. In Connecticut, it's $100,000 and most states say or 200 transactions. Connecticut says $100,000 and 200 transactions. In New York, they say $500,000 and 100 transactions. All the other states that have a transaction threshold, it says or. Now, this is really, really important. While this trend away from transactions is a very positive move, and it's going to benefit your clients, there's still just under 50% of states that have transaction thresholds, and some of them are fairly big states. You got in Illinois, you got in New Jersey, amongst these states that still have transactions. So as soon as I say there's a trend away from transactions, people say, oh, we don't have to worry about transactions anymore. That is not true. In some states, you still have to worry about it. Now, this is a free resource that we put out. And every time a state changes something, we update this. It's on our website under resources. Should be one of the handouts for today also. And this gives a lot of great information. Now, just about every software company out there, I mean, from Shopify to Avalara and everyone in between, says they've got software that will tell you when you've crossed the threshold and you need to get registered. Not one of them is granular enough to accurately tell you this information. For example, Shopify, they're just looking at the number of transactions or the actual revenue. But look how granular some of these can get. This is going to tell you about the effective date of the threshold, whether what the economic thresholds are. It's going to give you the monetary or the transactions. What the time period is based on. Is it previous calendar years? Is it prior 12 months? Is it previous calendar year or current year? It's going to tell you what's included or excluded from the threshold calculations. And this is important. I think this is more and more important. We just switched out one of these columns. And that's what tax type should remote sellers register for? Because we've seen them getting, registered for a lot of the wrong tax types. So this is going to tell you if you've got economic nexus, what you need to be signed up for. And then is registration required of all sales or marketplace sales? And then how long do you have? Once you cross a threshold, how long do you have in order to get registered? And then we have notes out to the side. Now, let's look at, it's kind of hard to read that chart while we're on here. Let's read a couple of states. So here's South Carolina. South Carolina says that their threshold is based on gross sales. They've never had any transaction threshold. This became effective on November 1st of 2018. So gross sales, and every state has a different definition of gross sales. I mean, to me, gross sales is gross sales. So in South Carolina, it's true gross sales. It includes all exempt sales, all marketplace sales, and sales for resale. South Carolina looks back to previous or current calendar year. So previous calendar year, very important around January. You look back over the course of the year. If you cross the threshold, then you should go ahead and get registered if your sales are taxable and material. However, sometimes you got to look at it throughout the current year. I was doing a project for a company, and they were a real small company. They were existing client. They were registered in like 2 or 3 states. And I did an end of the year Nexus review, and actually it was in about March or so, and they only gave me the previous year's sales. And I said, okay, you crossed 2 more thresholds, so you'll be in a total of about 5 states. And the salesperson came back to me and said, Mike, you need to look at year-to-date sales. I said, well, they didn't send them. And she said, well, I'll tell them to go send them. They were on Shark Tank and their sales have exploded. So when I looked at the year-to-date sales, I came back with recommendations of being in just over 20 states. Because that's how quickly their sales were growing. I mean, they were up like 800% in just the first couple of months of the year. So if your sales are exploding, it's really important you stay on top of them and try to anticipate rather than play catch up when you're going to cross a threshold. If your sales are, you're an established company and they're growing, 10% a year, and then you can wait later in the year. You don't have to be looking at this on a monthly or quarterly basis. So current calendar year can make a big impact depending on how quickly your sales are going. So the type of taxes, sales, and use, no registration is required if all sales are marketplace sales. And registration is required by the first day of the second calendar month after the threshold is met. So that's an example of how your state is looking at economic nexus. Let's look at some other states. So Illinois is going to be based on $100,000 of gross sales or 200 transactions. So this is one of those or states. It was effective on 10/1 of 2018. Now here they say gross sales of TPP. So it's only tangible personal property that are included in the threshold. But their gross sales exclude sales for resale and marketplace sales. But you include other exempt sales. So when I talk about the software not getting granular enough, this gets pretty convoluted in here. They look at the prior 12 months rather than the previous calendar year. Every quarter, you're supposed to check this. The type of tax is retailer's occupation tax, and it's got to be destination based. Big issue. This is one of the few taxes or few issues out there. It's not actually a tax, it's a concept that violates the 4-prong test. I mean, the reason being is if you are an in-state company and you're shipping from in-state, you are origin-based. So you got to worry about one rate. And when you're filing your returns, it's a pretty simple return. But if you have nothing at all in the state of Illinois, you haven't created Nexus any other way. You're a true remote seller. You're destination based. There are about 4,000 destinations in Illinois jurisdictions. So right away, figuring out the rate you need to use becomes a huge issue. And when you're filing a return, it's a nightmare. We've had to hire, 3, 4 people just to handle Illinois because you've gone from one location up to 4,000 locations. And the tax softwares aren't great at keeping up with that. So the type of tax, we think that this is discriminatory, and we think it's going to be a problem for Illinois at some point. However, it's an easy fix. They can make the fix retroactive. So I would not I would not say, oh, well, you know, your economic nexus is unconstitutional. I would go ahead and doing what you need to do. Now, what I would do is, if you want to work around on this, if you have someone creating Nexus, like a traveling salesperson or an independent contractor, and they're going into the state, now you sign up for the retailer's use tax, and you don't have to worry about collecting the destination. You don't have any of the local taxes you don't have to worry about. So that's the workaround in Illinois if you don't want to worry about getting all of these different local rates and filing in all those jurisdictions. No registration is required if all sales are marketplace sales. Registration required by the first day of the next quarter after the quarter a threshold is met. So if you cross the threshold in the beginning of this quarter, then you've got to register by the first of the next quarter. And as we said before, Illinois, very aggressive, auditing everyone to see if the correct Nexus date is being used. Florida, it's based on $100,000 of retail sales of tangible personal property, never any transaction threshold. It was effective in July 1st of 2021, one of the last states to impose economic nexus. Retail sales of tangible personal property. So you exclude sales for resale, marketplace sales, and all other exempt sales. So again, a little bit of a different in what's included in that threshold. Florida, based on the previous calendar year only. So in January, you look back over the previous year, and if you're over a threshold, then you should, and it's taxable and it's material, then you should get registered. If not, you can wait until the next January in order to take a look at that. The type of sales tax is sales and use, but you also have to collect the local discretionary sales taxes. No registration is required if all sales are marketplace sales, and registration required immediately after the threshold is met. So the very next sale could be taxable, and you could be responsible for it. So that's why I say on some of these, you got to be looking at, okay, I'm not over the threshold now, but I'm going to be crossing a threshold very shortly, and be anticipate. Register early is better than registering late, is what I was going to try to say there. All right, so here's New York, and this is based on $500,000 of tangible personal property. And so we've been looking at ORs. This is and 100 transactions. It was effective on 6/21/2018. That's the date of the Wayfair case. Gross sales of tangible personal property include sales for resale, marketplace sale, and all other exempt sales. The look back period is the prior 4 quarters. The type of tax is sales tax. Registration is required if all sales are marketplace sales, and registration required within 60 days after the threshold is met. So they give you a good 60 days. So that's a good thing. All right, so we're going to go to our first myth here. I don't have to worry about sales tax nexus if I am under the economic nexus thresholds. And I think we've shown during this first segment here that you don't have to worry about it. So, I mean, you do have to worry about it. It doesn't protect you from any other type of nexus. So if you're underneath the economic thresholds and have a physical presence, you still need to register. All right, so here are the rules for South Carolina. Out-of-state seller, you know, this is what they need to do in order to have a requirement to register and collect the taxes. Now, this looks pretty bare bones here to me. There's uh, a questionnaire that they put out that shows um, all of the things that they believe are included under this, and all states do this. So if you're just reading this information that comes, out of the statutes, you may be missing some things. So, and by the way, qualifies to do business in the state. That's with the Secretary of State. If that's in the statute, I think that you got to follow that rather than the this bulletin that was put out, because this bulletin, in one of the areas, it says that does not create nexus. Well, this bulletin is not authoritative where the statute is. So if someone is getting qualified with the Secretary of State, then I would go ahead and follow the statutes rather than this here. But if you look at this, I mean, all of these things come out of those statutes. So it's really expanding. And if you look at this, there's a lot of that third party stuff in there. Number two, the business authorizes an employee or third party, independent contractor, affiliated company, other representative to install, deliver, service, repair merchandise in South Carolina, or hires independent contractor to perform warranty or repair services on tangible personal property in South Carolina. The repairs may be under warranty for which there's no separate charge, or maybe under warranty for which there was a separate charge. So, you know, just that second one, we're going to get deeper into this, but South Carolina really stretches what the Supreme Court case says. And if you were looking just at the statutes, it's hard to see how all of these actually fit under that. So as we mentioned earlier, when we're talking about physical presence, we have a lot of activities that are obvious, some that are less obvious, some that are common, and some are very state specific. So when we think of real property and we think of a link or connection, I think we'd all agree that owning real property or renting it, if you own it in a state, or if you're renting it in a state, it could be an office, a warehouse, a factory. I think we'd agree. So this would be common nexus creating activity and obvious. What better way to create a link with a state than to own or rent something like real property? Now, this one's not so obvious. And in this day and age, we have a lot of companies tell us, well, Mike, I don't have any of these links or connection you're talking about. I'm a virtual office. Everything is done in the cloud. Well, unfortunately, the states don't look at it that way. You yourself, your client, are actually the link or connection with the state. So if you're in their state, you live there, or you're operating your business from there, that is the link. That is the nexus creating activity. And it's a very common nexus creating activity, although it's not so obvious. Employees. And this is becoming a much bigger issue now. I mean, since the pandemic, we've had a whole wave of employees working from home. And a lot of states said, hey, during this crisis, we're going to waive, all the rules where it says that employees telecommuting, working from home, create nexus. But the crisis is over, and we still have a lot of employees working from home, and this is becoming a much bigger issue. So if you have an employee who is working from home, either on a permanent or temporary basis, it's pretty much going to create a link or connection for you. Now, if they're not performing any work at home for you, if they just live there, then that does not. But if they're performing work on your behalf, that's probably going to create nexus for you. Now, some states look at what the remote employee does, but that's going to be the exception rather than the rule, as most states believe having an in-state employee creates nexus. So very common nexus creating activity, depending on who you are, may be obvious, may not be so obvious. And by the way, that goes for independent sales reps too. So we talked about this. We said that this is the biggest issue. Um, you know, independent contractors, making sales were uh, uh, the the scenario in Scripto and Tyler Pipe. It's one of the greatest area exposures out there. Very, very common nexus creating activity, one of the most common. Yet doesn't actually make common sense. So this would be not obvious. This would be less obvious. So this is one area that if you're going to be looking for anything on your client's behalf, I would be looking for this. And although those had to do with sales, it's really an umbrella activity right now. And I've got a list up on the screen. This is not an exhaustive list, but these are very common items that help to establish or maintain a market. They fall under that umbrella language. South Carolina, when we were reading through that, we talked about installations and implementations. But what we tell our clients is if you're sending someone into a state and they're going to be working with your clients or interacting with the public, that is helping to establish or maintain a market, and that's probably going to be nexus creating. However, if you hire someone on a 1099 basis to do your books or to develop some software, they're not interacting with the public. They're really not helping to establish or maintain a market. And those types of activities are not going to be nexus creating. So it's not all third-party activities. It's just those that help to establish or maintain a market. And they don't have to be independent contractors. They can be subcontractors, independent contractors. They can be companies doing performing services on your behalf. And it doesn't even have to be labeled. If someone's doing something for you to help establish or maintain a market, that could be an issue. Now let's do a case study here. This was an Amazon seller, and this was early on. This is before Amazon was collecting for someone. I think Amazon had maybe had 8 or 9 warehouses at this point. His home state did not have a warehouse. So he claimed he had a virtual office and that he had no location, and therefore he was not subject to this. And the state that found him was Missouri, and there was no warehouse in Missouri at that part. So the way that Missouri found him is they checked with the IRS to see who had received a 1099 in their state. And a lot of states do this. They information share with the IRS. And the reason why is because they're looking for those people. Remember, independent contractors, subcontractors, a lot of them are paid on 1099. So that's primarily what they're looking for. And he wanted us to, he came to us, he let us know this issue. He wanted us to defend him in an audit. He wanted us to use that virtual office issue, which we didn't think was going to work, but we said we would do it. And Missouri started chuckling at him and said, well, unfortunately, it doesn't work that way. You yourself live here. You operate your business from here. So you are the link or connection with Missouri. And we helped him out a little bit there. Some of the things he was selling were not taxable. So we got that overall number down a bit. But, it's hard to dispute that you don't live somewhere, that you're not operating the business from there. So unfortunately, Missouri had them, pretty much square in their sights. All right, so travel. It's not just where your employees live or where your contractors live, but anywhere they travel on your behalf. And, this is, a little bit hard to track for salespeople or independent contractors who are doing sales, because it's not going to show up on a invoice anywhere. So it's much lower on the radar. It still can be found. I mean, your competitors can tell on you. You could have a disgruntled employee tell on you. So it's still found, but it's much lower on the radar. This again is a very common Nexus creating activity, and sometimes it's obvious to some people and less obvious to others. If it's going to show up, for example, you have an independent contractor, an employee who is doing installations and you're charging for tax or even, reimbursements for travel. Since a lot of companies are found in the audit of someone else, if your invoice shows up in someone else's audit, that's how the state finds you. So that's a little bit higher up on the radar, and you got to look at that a little bit more seriously than something that would not show up on an invoice. I got a case study for that one. And this is a specialized software company. And 30 years ago, CPA said, hey, this was the fraternity brother of the owner of the company. And he said, hey, Nexus is created by traveling salespeople. So don't let your people travel and you're going to be okay. So for 25 years, there were no problems until they were contacted by a state who said, we believe you have Nexus. So the company said, no, we don't have Nexus. We don't allow our salespeople to travel. They do everything remotely on the phone. And the state said, well, we audited one of your customers and we have invoices showing reimbursements for travel. So obviously someone was coming here. And the company said, well, yeah, we have other people going there, but they're not salespeople. Well, the state says that's wrong information. It's anyone who's traveling on your behalf. And, installations are taxable in this state. So we want the last 7 years of back tax plus penalty and interest. And they also said, hey, most states are like this. So, you probably got a big problem here. And at that point, I got a call from the president of the company. And he was virtually in tears. He thought that they were going to jail, because they didn't do this correctly. And I talked him down and made him a little bit more comfortable, told him, hey, no one's going to jail for this. This wasn't done on purpose. He says, well, maybe I should be going to jail because we're going to be broke. Our bank finds out about this. They're going to pull all our credit lines. And, we owed over $500,000 in this one state. We're looking at greater than $3 million all across the country. So again, I had to talk him down, I had to let him know that there are programs we can utilize. And he said, well, unless you can convince the bank, we're still out of business. So we had to talk to the bank and let them know about the programs. And, there were some other things that we could do to get that, I'm sorry, they thought they were going to be paying 15 million, not 3 million. So we told them we would be able to definitely get it down below 3 million and possibly as low as $1 million. And the bank said, how sure of this are you? I said, we're sure of the $3 million number. We feel good about the $1 million number. So what the bank did is not only allow them to keep their credit lines, they loaned them the money to get all of these states, 40 plus states, done at one time. And generally that can be part of the problem. You got to, when you're doing something like a voluntary disclosure agreement, yes, there is a shortened look back period. And yes, you get penalty and sometimes interest waived, but you still got to pay some tax. So a lot of companies don't have that on hand. And a lot of companies do this one bite at a time. We're going to do the first 5 states and the next 5 states and so on. But this bank went ahead and loaned them the money to get them all done at the same time. And, when all was said and done, if you take our fees out, it was just about $1 million that they had to pay. And I have never seen anybody so happy to pay $1 million. I mean, they were ecstatic. but you got to know where they're coming from. They really thought they were going to jail, then they thought they were going out of business, and here they are. They've got everything fixed. Good relationship with their bank still, and compliant going forward. So that brings us to the myth number 2. It's never been a problem before. And we've been doing this for 25, 30 years. It's not going to be a problem now. Those are famous last words. I could give you a million stories, just like the one. 25 years was never a problem. Then it was a huge problem. So that is myth number 2. Now, ownership or rental of tangible personal property. So if you lease or rent to others, that could be a problem. So the I'm sorry. I'm like Pavlov's dog here. Heard a bell ringing. If you lease or rent to others, you now own property in another state if they cross state lines. So it could be inventory. Well, you're not leasing or renting to others, but you could have real property in another state like inventory. But equipment, this is a very common Nexus creating activity. It happens all of the time, and states are fairly aggressive on it. It seems to be less obvious because a lot of people have these problems. They don't realize it. And you know, let's go to the case study here. This is a camera leasing company, and you know, they were leasing high-grade camera equipment all over the country. And Massachusetts found them. They audited one of their company customers, and they contacted this state, said, "Hey, how long you been doing this?" And they said, "We've been doing it forever, 20 plus years." And Massachusetts told them, "You're doing it wrong. You've got Nexus with our state because you own tangible personal property in our state." Company said, "We can't be doing it wrong. Everybody in our industry does it this way." And Massachusetts said, "Get us a list of everyone in the industry and we'll go after them also." So we got a call from one of their other competitors. That's how we found out about this story. And Massachusetts contacted them and said, "Hey, your competitor gave us your contact information and said that you were doing this wrong." So they called us and said, "Hey, is Massachusetts correct?" And unfortunately, we had to tell them, yeah. So we defended them in an audit against Massachusetts. Some of what they're doing was not taxable, but a lot of it was. I mean, they were square in the crosshairs of Massachusetts. Hard to get out of that. And they had the same exact problem in every state across the country. So then we helped them get compliant across the country, doing, some amnesties and some voluntary disclosure agreements. So, very important here. You can't always follow the leader. Who says the leader knows what they're doing? They may be absolutely blind to this issue. It doesn't matter how big the company is. Even big companies have huge problems. So you don't want to follow the leader. This is a perfect example of that. And this is a perfect example of, leasing tangible personal property into another state. While we're here, everyone thinks Delaware is a state that does not have a sales tax, and they don't have a sales tax. However, if you are leasing into the state of Delaware, leasing tangible personal property, well, right away, you've got Nexus, and there is a tax to be paid by the lessor that needs to be collected from the lessee. So there's a use tax in the state of Delaware if you are renting property into the state. All right, so trade show attendance. This is one that is different in every state. There's basically 5 thresholds that the states use. Now, some states say if you attend as a consumer, that is enough to create Nexus. Now, I don't think that they're going to be able to win that. I don't actually see the states trying to enforce that, but a lot of them have answered surveys, and they put out guidance saying that that's what their rules are. Most of the states say if you participate as an exhibitor, then that is going to be nexus creating. Some states, say, hey, you can be an exhibitor so long as you're not doing active solicitation. Kind of hard to draw a line between that sometimes. Other states say, hey, you can be an exhibitor, you can actively solicit, you just can't take an order while you're here. And then you got Nevada, who wants everyone to come to Las Vegas. They say you can sell and collect tax once a year without creating Nexus. So any tax that you collect while you're at the show can either be turned into the promoter of the show, or when you get home, you mail it into Nevada. And if you're just doing that once a year, then it doesn't create Nexus. You do that twice a year, it can create Nexus. Now, you can do as much active solicitation, as much participating as an exhibitor. It's just when you're collecting money and delivering product in Nevada that you got to worry about this. Now, also, this is one area where states are good if they have de minimis exemptions at spelling it out. Most of the time, states don't spell out de minimis exemptions, but there are a number of states that say, hey, if you're here less than 2 weeks, it's not nexus creating. If you're here less than 2 weeks and less than $100,000 in sales developed from the trade shows, it is not nexus creating. Some states don't have de minimis exemptions, but each state is going to be a little bit different. All right, so delivery in your own trucks. This is, very common. May not be obvious, but it doesn't matter if that truck is owned or leased. Doesn't matter if it's a captive company. If you have a relationship with someone who does not hold themselves out to the public as a trucking company or a transportation company, then that can create nexus for you. And this becomes a big deal. State of New Jersey is notorious for this. And as you drive into the state, you see these weigh stations that the trucks have to pull over. Sometimes they have revenue agents in those stations, and they can impound the trucks. We've had calls that say, hey, we need a sales tax bond because they just impounded our truckload of goods. It happens in ports also. California is a big one with ports, and as the goods come in, revenue agents are there and they can impound them. And once again, we're getting sales tax bonds to get the good released. So very common, not so obvious. All right. We sort of mentioned inventory, and inventory creates physical presence nexus in most states, whether it's consigned, stored, or carried by sales representatives. Now, even though Amazon is collecting the tax, the inventory in most states still creates nexus. Now, there have been a couple of changes since Amazon started collecting tax. So in Arizona, unless you're shipping the inventory directly to an Amazon warehouse in Arizona, it no longer creates nexus. In Texas and in Illinois, if that inventory is just being used to facilitate Amazon sales, then it doesn't create nexus. But nowadays we see sales going to Shopify being fulfilled by Amazon. And that would create nexus. If you're only using it for the Amazon sales, does not create nexus. If you're using it for other reasons, it can create nexus. Related entities, if we see that third parties, true third parties can create nexus for each other. Related entities, much lower threshold. In some states, they say common ownership with similar names and products is enough to create nexus. By the way, click-through nexus or affiliate nexus, this has gone away since the advent of economic nexus, but not all states. And the way this came about was Amazon had people sending them business, and if someone purchased, they did it through a link, then if someone purchased within the next 90 days or 60 days or whatever that was, then a referral commission was paid to the referrer. Well, New York looked at this and they said, hey, if in Tyler Pipe, one independent contractor is enough to create Nexus, wouldn't a whole state of people who are sending business to Amazon and getting a referral fee or a commission fee for that, wouldn't that be much greater? Well, it went to the highest court in the state of New York and they agreed. And, right after that happened, this was about 2008 or so, a bunch of states followed suit. I think there were 21 states in all, and the thresholds were anywhere between, there were thresholds, but this was physical presence. This was just like Tyler Pipe, where they said, hey, you've got these independent contractors selling for you in these states. But they said that these independent contractors had to be generating, $5,000 a year or $500,000 a year. Most states have done away with this. Some states still have it. So you got to look out for this. You may be thinking, hey, you only have 2 years of economic nexus, but you may have click-through nexus issues, which are going to be a lot longer than 2 years. Use tax notice and reporting requirements. This came about back in 2010 or so. The state of Colorado wanted some online revenue, but there were no warehouses in Colorado at that point. So they couldn't force companies to try to collect and pay their taxes. They went another route. They said, we're going to make your life so stinking miserable that you're going to volunteer to collect the taxes because that's going to be a much easier route to take. And when they came out with this, we thought they were absolutely out of their mind. And what they were saying is you got to send a series of 3 or 4 notices. Number one, there's got to be something on your website that says, hey, we don't collect tax, you're responsible for the tax. Then there's got to be a notice that goes to the customer at the point of sale. And then there's got to be another notice sent at the end of the year reminding them if they haven't paid their use tax yet, they've got to pay it. And then, most of the states required that a list of the customers be sent there. Well, at worst, that was a horrible marketing message. Since we're not, what a lot of your customers heard was, since we're not collecting the tax, we're not doing our job, we're going to make you do it, and we're going to ensure that you do it by handing a list over to the state. You're going to be on that list. Not a great marketing message. This went through the courts for roughly a little less than 8 years. And the Supreme Court said this is not a tax, so they sent it back to the lower court. The lower court said, okay, Colorado, you can move forward with this. And it was appealed back to the Supreme Court, who refused to hear it. So we saw a lot of states jump on this bandwagon. And like I said, most of the states have overturned this. And by the way, Colorado turned out to be the sane one. Some of these states, they had very minimal penalties. These other states, Oklahoma is the absolute worst. The threshold, number one, is $10,000. And if you violate it, there's 3 things that you can be hit for. So how many transactions does it take to get to $10,000? Let's say it's 1,000 transactions. And the penalty is 20% of your revenue into the state of Oklahoma. So if you have $10,000, that's $2,000 for each violation. So that's a potential of $6,000 per violation. And if you have 1,000 sales, 1,000 times $6,000, I mean, oh my gosh, it's draconian. So you've got to look at Oklahoma. Vermont, it's like Colorado was, very little on the penalties. So most people wait till the economic nexus kicks in. Puerto Rico, um, we tell a lot of our clients just stop selling there because, on 4 sales a year, you could have $30,000 in penalties potentially. So unless you have a good amount of sales going to Puerto Rico, or your clients have a good amount, just skip it. If you're selling to Puerto Rico through Amazon, that doesn't count. But if you're selling into Puerto Rico through any of your other platforms, then that would count. All right, so if you want to see how crazy some states can get, this was before Wayfair. Some states consider software tangible personal property even when it's downloaded. State of Texas is one of those states. And when you're licensing software, you're usually not selling it outright. You're usually keeping some type of ownership interest in it. So in this instance, there was a Utah customer. He downloaded tangible personal property, and the state said, well, since you have an ownership interest in this tangible personal property now, you now have a physical presence here in Texas. Now, that was a real big stretch. It was an end run. I mean, it was all based on technicalities. And this was fought. And there was a decision hearing. Texas Controller of Public Accounts, the ALJ, agreed with the Texas Comptroller. So this went to the courts after that, and it was a closed opinion, decision, settlement. And so it's not public. No one knows what happened there. And I think that Texas said, okay, we'll settle because we don't want this to become a public information. And Texas continued going down this route. And when someone took them to court, there was a closed settlement. So Texas knew what they were doing was wrong. I mean, this was obvious to everybody it was wrong, yet Texas kept doing it. All right, so these are handouts that you should be getting. If not, they are on our website under the resources tab. This is 10 common Nexus creating activities for sales and use tax. And when we say common, that means that most states, if not all states, utilize these activities to create Nexus. And this is in direct contrast to these 12 state-specific Nexus creating activities. And in some, maybe it's just one state that considers this to be a Nexus creating activity. So this is widely different amongst the different states. However, if you're trying to figure out what your client's Nexus footprint is, you should look at these in certain states. All right, so how do states find you? Well, number one, auditing your customers. If you're selling on a business-to-business basis, the auditing of your customers is one of the biggest ways you get found. If your audit shows up in that invoice, in that audit, if your invoice shows up in your audit, the states use that as prospecting. I mean, when an auditor comes out there, they're looking at your sales. They want to make sure that the right amount of tax has been collected on all of the transactions. They want to make sure that all of the tax has gotten remitted. So that's the primary. But the secondary, just because your vendor doesn't charge you sales tax, doesn't mean it's tax-free. So they want to make sure that you're paying tax on your taxable purchases, but they're also using that as a prospecting list. Some states very formal. In Texas, lead cards have to be submitted. In other states, you just get put on a list. And getting put on a list is not horrible. You may not have to collect sales tax. Maybe you don't have Nexus. But these lists are followed up on by the discovery units. That's the units within each state that their purpose is to find new taxpayers. So they follow up on these leads. We talked about information sharing with other states or with the IRS. The IRS states go out and get lists of people who have received 1099s in the state, and then they match it up to see if they're collecting any other taxes. And when we say information sharing with the other states, the Southeast is big on this. The Midwest is big on this. But it's not, your information, when one state finds you, they're not going to share it with all of the other states out there, just the states within their sharing arrangement. And while auditors are supposed to be discreet and not share information, there are informal groups of auditors out there who do share information. So once one state finds you, generally you have a couple of other states following up 6 months down the road. Amazon, you ask Amazon for a list of sellers, they're usually going to give it to you at this point. Web surfing, this is a big way. Some states, they have their discovery units do it on a manual basis. Web crawlers, it's specialized software. I mean, the state of Washington is a big company that does both, a big state that does both of these things. And sometimes, it's silly the way companies get found. They've got on their website, only pay sales tax in these 5 states. Well, they're listed as one of the 100 biggest coffee companies out there. And they sell urns and all sorts of tangible personal property in addition to the beans. So our salesperson comes back to me and said, hey, this guy doesn't believe me. And, unfortunately, a lot of people we talk to don't believe us, when we tell them about Nexus. So I told them to go back and say, hey, at least take this portion of your website down. I mean, an auditor doesn't even have to go on your website. Right here on the Google listing, there's a page that says only pay tax in this state. That's a giant red honking neon sign saying all states come here. We've got problems. All state auditors, please call on us because we got problems. So we told them to take that down. And they never did. So maybe they got found, maybe they didn't. I mean, you can always, lead the horse to the oasis, but it's not always going to drink. But that's a big issue. And we see it all of the time. And remember, independent contractors do create Nexus. So if you're saying on your website, well, we've got relationships all across the country, we can, get one of our independent contractors to install this for you. Big red honking sign. I got problems everywhere. So web surfing, web crawlers, what you have on your internet, on your website could be a big issue for you or for your clients. So also leads. I mean, former employees, they knew you should have been collecting sales tax. They're disgruntled. Not only do they get the pound of flesh by turning you in, but they could get paid for doing it. There are states that pay bounties. Competitors, and this is becoming a bigger one, since Economic Nexus, a lot of people want to get registered for Economic Nexus, but they're selling big ticket items and their competitors are not collecting. And they're saying, Mike, I believe you. I want to get registered, but I can't take the hit to my sales. Is there any way I can turn these people in? Well, yeah, most websites, unfortunately, if this is you, most state websites have some place where you can report non-compliance. Sometimes you can do it anonymously. Sometimes you can do it and get a bounty for it. But all states have some way to report non-compliance. Customers. Maybe you get a disgruntled customer and they turn you in. Maybe they get audited and, they tell on you. Maybe it's very innocently. Maybe they call up the state, use tax is a big issue, and they say, hey, my vendor didn't charge me tax on this, and I need to know if I need to self-assess use tax. And next thing you know, the state's saying, who's your vendor? And you're on a list. And then some states purchase lead lists. Some get them from Amazon. Some just go out from these lead list brokers and buy a list. So that's how states find you when you're not registered. Just a couple of ways. These are the biggest ways. So why Nexus matters more than ever? Well, with this economic nexus, states were gearing up to track down sellers prior to the pandemic because they had been waiting since the Quill case to figure out how to get a piece of your online revenue. They finally have it. They gave everybody a little bit of time. They started gearing up. Then the pandemic hit. And they paused everything, but now they're starting to get back up. They know from these surveys that somewhere between 56 to 60% of sellers are not compliant. I think this is going to get ugly, and it's already started in states like Illinois and Wisconsin. So while they're gearing up, while they're going after you for economic nexus, they're going to stumble across all types of nexus while they're looking for this economic nexus. And economic nexus is going to be bad enough. You're going to have 4 or 5 years of that. But on this physical nexus, like independent contractors, maybe you've had them for 10 years. That's where your greatest exposure is going to be. And some states, right now we're either in a recession, the edge of a recession. I mean, no matter what your thoughts are, states are starting to see revenue dry up since the pandemic. So they're going to need to make up revenue historically. Coming out of a recession, going into a recession, whenever the state's revenue starts to dry up, we've seen increased discovery efforts. So we've already seen the states starting because of economic nexus, and they want to make sure everyone's compliant. And now you're throwing gasoline on that file with a recession, potential recession, lower revenue being received by the states. It's really going to be the perfect storm out there. So this is why you want to be proactive rather than reactive with your clients. You want to get them to act now. So myth number 3, registering for sales tax creates income tax nexus, and that's just not true. Income tax nexus is separate from sales tax nexus. Now, some of the activities that create sales tax nexus are going to create income tax nexus, but just registering for sales tax does not create an income tax nexus. It may create an automatic registration for income tax or franchise tax, but it doesn't create income tax nexus. So I want, one of the reasons people say we're not paying attention to economic nexus is because we don't want to worry about the income tax. And I got news for you. The next big battle for online sellers is going to be income tax, and we've already started to see it. That's a whole nother webinar, though. We'll save that for another time. But this is a myth. Myth number 4, you have to register with the Secretary of State when registering for sales tax. You do not, especially if you just have economic nexus. All states have workarounds. They sometimes hide those workarounds. They make it look like you have to register with the Secretary of State. And if you have certain types of physical nexus, you may have to register with the Secretary of State. But in general, especially if it's an economic nexus, you do not have to register with the Secretary of State. All right, so I want to talk about some common registration mistakes real quickly. When you're registering, you use the wrong type of tax. Registering for sales versus a seller's use tax or vice versa. Registering with the Secretaries of State, which we just talked about. Entering the wrong start date. You may do this inadvertently, you may do it on purpose, but if it's done inadvertently, it can create lots of problems for you. And then registering through the streamlined sales tax, I am not a fan of that program at all, because once you register through that, you are limited as to who can do your sales tax returns. So I am not a fan of software companies doing sales tax returns. They're software companies. They're good at doing software things, generally not good at doing services. So don't get registered with the streamlined unless you are comfortable with a software company who's going to be doing your returns. So What should sellers do? Well, sellers should register whenever there's Nexus. What they sell is taxable, the exposure is material, and a marketplace is not collecting. And then, of course, we talked about materiality earlier. Materiality is my comment, not the states. Most states believe you should register from dollar number one. It's me who talks about taxability. So, excuse me, materiality. Ways to register. You can register prospectively, which simply means that you're going to register with today as the start date or the end of the month as the start date, or the first of the month as the start date. Going forward is what you're going to worry about collecting and remitting the taxes. Sometimes this is what you need to do. Maybe you just crossed the Nexus line. Other times, companies do this as a way to avoid all the back taxes. And they're saying, listen, I just don't have the ability to pay all the back taxes, but I want to stop the bleeding. I want to stop this from accruing any further. And I know that those periods are still going to be open. And I know the state may still fine me, but I got to stop the bleeding. So they register prospectively. In some states, you know, like in Illinois or Wisconsin, you definitely want to do it. Some states not very aggressive at all, and they find you by mistake rather than actively looking for you. Registering historically is what states want you to do, or through a voluntary disclosure agreement. Historically means you use the actual date of Nexus, and then you're going to want to do back returns for all those periods since the registration. Now, states will work with you sometimes. They will waive penalty. They may also allow you to file annual returns in some of the earlier periods. So that is something you want to do. But if your exposure is material enough, then you want to look into a voluntary disclosure agreement. All of the voluntary disclosure agreements waive penalty. Some of them, like a Texas, waive 100% of the penalty and 100% of the interest. And they limit the look back period. So in California, the look back period is 8 years. If you go through a voluntary disclosure agreement, 36 months, that's a huge savings. You don't pay any back tax, any penalty, and any interest on any sales outside of the look back period. And in the look back period, you still have to pay the back tax. You still have to pay that would be 36 months. You still have to pay the 36 months of interest, but the 10% penalty is waived. So voluntary disclosure agreements are a great tool. They're not a one-size-fits-all tool. You have to look and see what makes the most sense. There are other exposure mitigation options. Look out, there's some software companies, I generally don't like to say it, begins with A, ends with A. They were telling everybody that, hey, if you owe more than $500, you have to do a voluntary disclosure agreement. And oh, by the way, we charge $3,500 for a voluntary disclosure. Why in the world would anyone pay someone $3,500 to remit $500 to them? I mean, that is absolutely ludicrous. People have come to us with $100,000 invoices before they pay a dime of tax and say, hey, does this look right to you? And leaving us, they have maybe a $20,000 invoice, and they're compliant everywhere. So we actually have a program, if anyone's interested. It's called an exposure analysis with a VDA cost benefit analysis, where we go in and say, it doesn't make sense to file a VDA here. And we'll, maybe recommend doing a historical registration instead, maybe recommend a prospective registration. So don't just take someone's word on it that you need to do a voluntary disclosure. Our rule of thumb is if you're not saving at least as much as the cost of the VDA, then the VDA doesn't make sense. There are exceptions to that rule. There are no absolutes in this. But that is the end of our presentation. I hope that everybody has enjoyed or at least learned something today. And we hope that you join us at our next presentation. We do a lot of work with SCAPA. And if you have any questions, there's a contact number up on the screen. Thank you, everyone. Bye-bye.